By the time Daniel Harris checked his banking app, it was already too late. The 6 figures he had spent more than a decade saving were gone, replaced by a strange new line on his screen: bail-in conversion to bank equity. The money he thought was safest in the world had just been turned into the very thing that was collapsing. On screen, title card, the bail-in trap, plus fast flashes of a crashing bank stock chart, crowds outside a branch, a notice that reads, "Account frozen." It was a cold Monday morning, just after 7, when 42-year-old Daniel Harris realized his savings were no longer his. Outside his small brick house in a quiet suburb, a white envelope with the logo of Harborline Bank waited on the doorstep. The words "Customer Notice Resolution Measures" were printed in bold red letters across the front. Inside, his phone would not stop buzzing. Direct debit declined. Mortgage payment returned. Card transaction rejected due to insufficient funds. Daniel wiped sleep from his eyes, opened his mobile banking app, and felt his stomach drop. The familiar comfort of nearly $200,000 in savings was gone. In its place, he saw 3 lines. Everyday account, just over $20,000. Resolution equity units, amount equivalent to more than $100,000. Temporary overdraft, a few $1,000s in the red. Underneath, a cheerful banner read, "Harborline has been successfully stabilized under new resolution rules. Thank you for supporting financial stability." His hands trembled. This was not a hack. Next to him on the kitchen counter, the letter lay open, full of dense legal language and smug certainty. It explained that, due to extraordinary market conditions, Harborline Bank had entered a weekend resolution process. To protect the financial system and avoid burdening taxpayers, a portion of uninsured deposits had been converted into loss-absorbing instruments. In plain words, large savers like Daniel had just become unwilling investors in a bank that had nearly destroyed itself. On the living room television, the news anchor spoke over footage of long lines outside branches. "Authorities stress that small insured deposits remain fully protected," she said. "However, under the new bail-in framework, larger depositors will participate in the recapitalization of failing institutions." Daniel barely heard her. He saw only the shrinking number on his screen and the words, "Conversion completed." His wife, Anna, entered the kitchen in her robe, looking confused. "What happened?" she asked. Daniel opened his mouth, but nothing came out. For 10 long years, they had skipped vacations, driven an aging car, and said no to almost every luxury to build that safety net. They had chosen the big, famous bank precisely because it felt safe. Now, that safety had been turned into a weapon pointed directly at them. 3 months earlier, Daniel believed he was finally doing everything right with money. Today, he was learning the hardest possible way that a bank can legally decide his savings belong to its survival, not his future. To understand how he ended up here, we need to go back to 90 days earlier. 90 days earlier, Daniel was just another exhausted middle-class worker in a city that never seemed to slow down. He worked as a project manager for a mid-sized construction firm, spending his days juggling deadlines and disputes. His salary was decent on paper, but once taxes, mortgage payments, and school fees for 2 children were stripped away, the leftover amount felt embarrassingly small. Every month, more than a third of his income disappeared into the house payment on their modest 3-bedroom home. A chunk went to the car loan they still had not finished paying. Another portion was quietly routed to help his aging parents cover medication and rising utility bills. By the time groceries, gas, and the occasional family treat were paid for, there was very little breathing room left. Daniel's one point of pride was his savings. Over more than 10 years, he and Anna had slowly built an emergency fund, then a house repair fund, then a college fund for their kids. Step by step, withdrawal by withdrawal, they had reached a balance that made him feel, for the first time, almost safe. At night, when everyone else was asleep, he would sit at the small kitchen table with his laptop and scroll through financial headlines. New crisis risk in the banking system. Another mid-sized bank rescued after deposit run. Politicians promised no more taxpayer bailouts. He remembered the global financial crisis from his 20s. Back then, he had watched his parents' retirement account shrink and their bank stocks get cut in half. They had talked about bailouts and too big to fail, words he only half understood. Now the vocabulary had changed. He kept hearing phrases like bail-in regime, resolution planning, and loss-absorbing capital. The experts on television sounded confident. They assured everyone that the system was safer, that new tools allowed authorities to stabilize failing banks without using public money. But Daniel noticed something else. The more the experts said, "Do not worry," the more his chest tightened. He was not trying to become rich. He just did not want one bad headline to erase a decade of sacrifices. His friends joked about buying risky coins, trading options, or flipping houses. Daniel did none of that. He thought of himself as the cautious one, the grown-up in the room. Still, beneath that caution was a constant simmering fear. The fear that the rules would change again, and once more, people like his parents would be the ones left holding the bag. One night, after reading yet another article about new bail-in tools, he stared at his banking dashboard and muttered to himself, "There has to be a place where money is actually safe, a bank they would never let fail." That single sentence was the first quiet step toward the bail-in trap. The trap did not arrive as a scam call or a flashy investment scheme. It arrived dressed as safety. It started with a glossy email from Harborline Bank, the largest and most prestigious institution in Daniel's city. He already had a small checking account there for everyday transactions, but most of his savings sat in a smaller local credit union. The email subject line read, "Introducing Fortress Savings, built for the new era of bank safety." Inside were carefully chosen phrases, aligned with the latest government resolution standards, designed to keep your deposits secure in any market environment. Extra protection for customers who consolidate their savings with us. The images showed happy families, smiling retirees, and a massive steel vault door glowing with blue light. At the bottom, a line in friendly font, "Sleep better knowing your savings are with a system-critical institution." A week later, Daniel received a call inviting him to a financial health review at his local Harborline branch. He accepted, half curious and half anxious. The branch smelled of coffee and printer ink. A young manager named Claire, in a navy suit and perfect smile, greeted him. "Mr. Harris, thank you for coming in," she said. "We've been reviewing how customers like you can benefit from the new stability tools regulators have created. The old crisis model of taxpayer bailouts is gone. Now we have something much safer, bail-in and resolution planning. It keeps the system stable and protects customers." Daniel frowned slightly at the unfamiliar terms. "Bail-in?" he asked. Claire nodded, sliding a brochure across the desk. "Think of it like this," she explained. "Instead of governments rescuing banks with public money, there is a clear plan. Large institutions like Harborline follow strict rules. In an extreme situation, the bank has tools to fix itself without collapsing the system. It is all about stability." She emphasized the words strict and stability with practiced ease. The brochure was full of reassuring charts and bullet points. At the center, in large letters, were the words, "Fortress Savings, benefit from our strength and regulatory protection." Claire continued, "Customers who move their savings into Fortress accounts enjoy priority protection in resolution planning. Regulators focus on institutions like ours. You can be confident that your money is part of the safest segment of the system." To Daniel, it sounded like an upgrade from his small credit union, which no one ever mentioned on the news. Harborline had television ads, skyscraper offices, and a logo everyone recognized. What he did not see, buried deep in the terms and conditions, was a sentence explaining that deposits above the insured limit could be treated as bail-in eligible liabilities. He left the branch feeling strangely lighter. He told himself he was not chasing yield, not gambling, not chasing a shortcut. He was simply moving his family's savings into the safest fortress he could find. That is how this particular trap works. It does not tempt you with sudden wealth. It tempts you with relief, the promise that, for once, you can stop worrying. The plan sounded so reasonable that Daniel almost felt guilty for not doing it sooner. On a quiet Thursday evening, after the kids were asleep and Anna was reading on the couch, he opened his laptop at the kitchen table. The Harborline portal awaited him with cheerful colors and simple buttons. A banner at the top said, "You are pre-approved to upgrade your savings to Fortress status." The steps were presented like a checklist. Transfer existing savings from external accounts. Consolidate balances into Fortress savings for enhanced stability. Review and accept updated terms. Daniel pulled up the website of his old credit union. The logo looked small and plain compared to Harborline's sleek interface. The account balance stared back at him, a quiet monument to 10 patient years. He hesitated. The credit union had never given him a single problem. The staff knew his name. They had helped him once when a payroll glitch delayed his salary. The place felt almost old-fashioned. But could a tiny local institution survive some new crisis when even major banks sometimes made headlines? He remembered Claire's words. System-critical institutions with resolution tools are the safest place for serious savings. He thought about his children's college fund, his parents' health, the house they had fought to keep during tougher years. If Harborline was the bank regulators watched most closely, did it not make sense to be there? He clicked through the transfer forms. Move full balance from external savings, he read. He clicked yes. The progress bar filled. A notification popped up. Congratulations, Daniel. Your savings are moving into Fortress status. A little confetti animation ran across the screen. Then came the final step. Accept updated Fortress terms. He scrolled quickly, eyes sliding past dense paragraphs about eligible liabilities and resolution measures. One line did catch his eye for a moment. In extreme circumstances, certain large deposits may be subject to bail-in, including conversion into equity or partial write-down, in accordance with applicable law. He frowned, but the phrase extreme circumstances soothed him. Surely, if things ever got that bad, the government would step in somehow. Besides, he told himself, that was exactly why he chose a big bank in the first place. Harborline would be the last one standing. He clicked accept. In a matter of minutes, 10 years of slow, careful saving flowed into a single institution under a new set of rules he did not fully understand. Daniel did not feel reckless. He felt responsible. No one ever thinks, I am handing my safety over to a legal clause I have not read. They think, I finally did the grown-up, sensible thing. At first, the choice seemed to pay off. Weeks went by. The app showed his Fortress savings balance growing ever so slightly, with the modest interest rate Harborline paid. A small progress bar, labeled Family Security Goal, crept slowly toward completion. Daniel checked the app at lunch breaks, in line at the grocery store, sometimes just before bed. Each time he felt a little calmer. The world might be unpredictable, but his money was parked in what television pundits called one of the country's most important financial institutions. Then the headlines started to shift. At first, they were small. Harborline reports unexpected derivatives losses. Analysts question banks' risk models. Shares down following earnings announcement. Daniel shrugged them off. Big banks were always in the news. That was part of being big. But the tone grew darker. Regulators monitor liquidity pressures at Harborline. Large investors reduce exposure amid uncertainty. Concerns rise over health of system-critical lender. On a Friday morning, Daniel tried to transfer a few $1,000s from Fortress Savings to his everyday account to cover upcoming bills. The app showed a spinning circle and then a message. Temporary transfer limits in place due to system maintenance. At the branch, a printed sign appeared on the door. We are experiencing unusually high transaction volumes. For your safety, some services are temporarily limited. Customers lined up at the cash machines, which gradually began to display smaller withdrawal limits, then only allow balance inquiries. On Saturday, social media erupted with videos of people waiting in long queues, arguing with staff, asking why their transfers were frozen. That evening, the government held a press conference. The finance minister, flanked by stone-faced regulators, spoke carefully. Harborline Bank has entered a planned resolution process under our new bail-in framework, she said. Let me be clear. The system is stable and insured deposits remain completely safe. We are using modern tools to ensure the institution can continue vital services without costing taxpayers a cent. A reporter asked about larger deposits. The minister replied with phrases like bail-inable liabilities and orderly recapitalization. The words were precise, but to most people watching, they sounded like a different language. On Sunday night, while Daniel tried to pretend everything was fine for the kids, his phone buzzed with an email. Notification of resolution measures affecting your accounts. His vision blurred as he read. Deposits up to the insured limit would remain untouched. Amounts above that threshold would be converted into resolution equity instruments to strengthen the bank's capital position. Access to large withdrawals would be restricted while the new structure settled. In one weekend, his life savings had been redefined not as a cushion for his family, but as raw material to repair a broken institution. When markets opened on Monday, Harborline's new equity units began trading. Their value slid downward all day. On Daniel's app, a new section appeared under investments, showing a number he did not want to look at. The news celebrated the successful use of bail-in powers and praised the fact that not a single dollar of taxpayer money had been used. For Daniel, it felt like the opposite of success. Mortgage payments bounced. Automatic debits for tuition were declined. Every buzz of his phone now meant another bill demanding money that no longer existed. And that is how we return to the white envelope on the doorstep. The line on the screen that read, "Bail-in conversion completed," and a man standing in his kitchen, realizing that doing everything right had still turned him into collateral. So, what actually went wrong here? This is not just a story about Daniel Harris. It is a blueprint for how the bail-in trap can catch anyone who thinks safety is something you can outsource completely. There were 4 big mistakes. First, confusing system safety with personal safety. Daniel heard experts say the new rules would make the financial system more stable. That was true. Bail-in frameworks are designed to keep banks functioning and protect taxpayers. But the system and the individual are not the same thing. In an emergency, the system cares about stopping a panic, not about preserving one family's nest egg. Second, believing bigger automatically means safer. Harborline's skyscraper television ads and status as a system-critical institution impressed Daniel. He assumed that regulators would never allow such a bank to fail in a way that hurt customers like him. In reality, the new rules explicitly assume that large institutions will use big depositors as shock absorbers. Concentrating almost all his savings in one place turned cautious diversification into a single point of failure. Third, not understanding what a large deposit really is. On the app, Daniel saw a comforting balance and the word savings. Legally, deposits above the insured limit are often unsecured loans to the bank. That means he was not simply storing money in a vault. He was lending it to an institution that could, under certain laws, restructure that loan by turning part of it into shares or writing it down. Normal people rarely think in those terms, but the legal system does. Fourth, treating legal language as background noise. When Daniel saw the phrase, "in extreme circumstances, certain large deposits may be subject to bail-in," he did what almost everyone does. He assumed extreme meant so unlikely I can ignore it. He clicked accept and moved on. But contracts and regulations are not decorations. They are loaded weapons sitting quietly on the table, waiting for the day someone decides to pick them up. None of this means you should stuff cash under a mattress or live in constant fear. It does mean you cannot afford to be completely passive. You need to know where your money sits, how much is actually insured, whether you are concentrated in one institution, and what the rules say can happen in a crisis. Daniel's not stupid. He is not greedy. He is exactly like millions of careful savers who only want peace of mind and believe that a familiar logo and a reassuring brochure are the same thing as protection. The good news is that you are hearing his story before you make his mistakes. This is how banks can legally take a chunk of your money in a crash, not by breaking the rules, but by using the rules exactly as they were written. Your job is not to panic. Your job is to understand the game you are playing before someone else decides you are part of their resolution